Yesterday, there were three things that affected markets. Number one, new coronavirus fears. Number two, consumer weakness. Number three, tech tariffs. And I hate to say it, but if a growth scare does materialize from here, we could fall further on our markets. Now, I know the bears are going to love that, but really, it would be an opportunity. Now, the question is, the big question in all reality, are we going into a recession? Because here's the deal. Growth scares cause corrections. Bear markets are caused by recessions. Now, the bulls will be delighted to hear, in really the past 4 or 5 decades now, we don't go into a recession for no reason. It's usually some kind of event that pushes us into a recession. I don't see that event right now, but we do need to be on the lookout for any kind of big event. Now, let me be honest. The coronavirus fears, they're probably over. As long as you don't see human-to-human transmission in China, then this is probably something that will just go away. Because how markets work is you have uncertainty and you have fears, okay? Uncertainty is the big problem, okay? People don't know what's going to happen and it's hard to plan for that. We're really bad at handling, or really good at handling bad news, really bad at handling uncertainty. If we don't hear new information about this virus, then some of that uncertainty slowly starts to go away. Now, with something as large as potentially a new pandemic that is, in the coronavirus category, but it's different, is something that's even worse than what we experienced before, there's obviously going to be some fears about that, some incredible fears if that does start to spread human to human. But as long as it does not, I think that goes away. Consumer weakness is really what we want to pay attention to right now heading into this upcoming week, because here in this video, I will share with you why we are so concerned about consumer weakness, some of the recent data that we have gotten, but we do have more data coming this week that will tell us a lot more about the consumer and the state of the economy. Now, you have to remember, this is kind of a trade-off. If the economy weakens, then you get rate cuts. When the economy weakens, you get lower interest rates via long duration yields, like 10-year treasury yields, which are the basic instrument that controls mortgage rates, auto loans, credit card, interest rates, basically everything, business credit, literally like everything. Okay. It doesn't matter as much what the Fed does. We got to bring down those 10-year treasury yields. And that's really this current administration's goals. And in order to do that, you may need to see some weakness in the economy. Good news for the bulls is the economy is already, what the data shows, really strong. So to get some weakness from here is a far cry from a recession. The other good news is, if you are a bull, if you are in growth stocks, they actually should benefit from a slower cyclical growth environment. If a stock is offering you good growth and you can't get that in other areas, then usually that stock is more attractive. Of course, if we are not heading into some kind of recession at least. Now, I did go out and make a list of the specific reasons why there could be some growth concerns right now in the marketplace. Number one, Walmart warns about a slowing consumer. This is really the first time Walmart has done this in as long as we can remember. That's something to pay attention to. Retail sales last month were negative 0.9%, the worst in over a year. Number three, bad real estate data that continues to come out. It's just becoming an even bigger problem. Number four, Trump calls on Elon to get more aggressive cutting waste, and that happened today. Trump on Truth Social says Elon is doing a great job, but I would like to see him get more aggressive. Remember, we have a country to save, but ultimately to make greater than ever before. Elon Musk says, will do, Mr. President. And the government just giving out this free money is like giving out free grants. There's no accountability. I mean, you could take this money and do whatever you want with it. Like, a lot of this money is not being spent even for what it was supposed to be granted for. That is very stimulative. Whether that is right or wrong or not, it is stimulative. It does help to boost the economy. And cutting back on that is going to stop the free money. It's going to cut the party short, if you will, from that perspective. Now, I think there's probably enough organic strength and growth in the economy to, keep things going, but that is going to have a measurable impact on economic activity. So something to pay very close attention to. That will also bring down 10-year treasury yield. So that's the positive. Okay, economy weakening, bring down borrowing costs. That could spur more organic economic activity. Number 5 here I have 240,000 government workers will be fired. That is the target that the current administration is targeting. That is about 10% of the government workforce, but who knows? I mean, that number could get larger. And number 6, we had 37,000 deportations last month. So at the same time you have all of this other stuff going on, you also had 37,000 deportations, which is going to affect the labor market, at least eventually. And that's just 1 month. I mean, at a run rate there, if you get 37,000 times 12, I mean, you're going to be looking at something like 444,000 deportations this year. Now, that could pick up, that could slow down, something to watch, but that would take 444,000 potential workers out the workforce. Now, some of these people are, criminals, not necessarily in the workforce as a measurable statistic. So there's nuances here, but that would be problematic. Now, there has been some good news recently. Yesterday, Visa CEO went on CNBC and said the consumer is strong. And I imagine Visa, hopefully they wouldn't lie to us, right? There obviously could be conflicts of interest, because if they said the consumer was weak, I mean, Visa would probably go down, right? Because it's a payment processing company. But they have pretty good color into what the consumer is doing. And they say consumers are still strong. So that is a positive that we have gotten recently. And I will continue to update this with new information to build the bull bear case, if you will. Now, CNBC had Tom Lee on the program yesterday. Tom Lee says market sell-off is a buying opportunity. Now, I know some of you guys are going to say Tom Lee's a permabull. He always says this, and well, we shouldn't pay much attention to it. And, I don't care what that opinion is. I think it's important when, a lot of people are bearish to consider bullish opinions, to take in that bullish commentary. It helps you not to be like perma-beared, right? And I know a lot of retail investors really need to hear this. Vice versa, when markets are too optimistic, it's always good to listen to the bears, to see what in their argument resonates with you. That could be a risk factor. And that's why it's important to get contrarian opinions.
Off today as investors grow more concerned about a slowing economy. The Dow and S&P 500 turning in their worst session of the year so far. And joining us now is Tom Lee from Fundstrat Global Advisors. He's also a CNBC contributor. And Tom, it is great to have you on a day like today where the major averages are not only lower on the day, they're lower on the week. And the Dow, the S&P, and the Nasdaq are now also lower for the month of February so far. We teased it ahead of this conversation, the fact that you're seeing a contrarian bullish signal here. What is it?
Well, it's a couple things, but I'd say what really stands out to us is that the market has eluded extended periods of weakness because investors are bearish at the highs at a time when there's record cash on the sidelines. So to us, this is a market that is very skeptical of these new highs. That bearishness and concerns about tariffs means there's a wall of worry. So I think this is actually a very positive setup for stocks.
So you're not concerned about some of the data we've gotten? I mean, that University of Michigan consumer sentiment reading this morning in particular seems to have spooked investors, given the fact that it cited broad declines across age, income, wealth groups. You also said that big spike in year-ahead inflation expectations. That was unchanged, but the 5-year expectations moved higher, too. At what point does that start to manifest into something more meaningful in terms of a slowdown here in growth?
Well, these inflation expectation surveys matter to the Fed because they are concerned about whether or not consumers are actually raising their inflation expectations, and that would in fact be bad. But we have to keep in mind the UMich surveys do seem to be polluted by political affiliation. When you break down respondents by Democratic responses, they've gone from seeing inflation under 2% before the election to over 5% today. Republican respondents have gone from 4% to basically zero. In fact, if you look at the distribution of responses for those Democratic respondents, almost 7% think inflation is currently at 25%. So I think that there is a lot of pollution in that data, and I think it's probably pretty typical what happens when there is a change in administration, but I hope the Fed is aware of that political dynamic.
So, Tom, if I recall, in Q4 last year, you were warning about market turbulence, and we've been right now at around S&P 6,000. We're at the level where we were a month ago, a month before that, a month before that in late November. Should we also expect turbulence at these levels at this point, given that the macro narrative and the political landscape is still unclear?
It certainly seems like it. I mean, I think investors can cite a lot of things top of mind why short term they're expecting the turbulence. You know, we're coming off 2 back-to-back 20% years. We know there's significant uncertainty about tariffs. In our latest client survey, 63% of our clients, and that's over almost 2,000 respondents, said tariffs or deportations is the biggest risk. That's up from 54% last month. But these are not things that have necessarily long-term negative effects. In fact, things like the number of Fed cuts is actually back towards 2. And I think there's a possibility the Fed may actually make cuts sooner. I think one thing the market is being complacent on is thinking the Fed's on hold. But if this turbulence causes hiring to slow, I actually think the Fed could actually be making cuts a lot sooner, which would be positive for stocks.
Okay, so tell me about these granny shots that you've got, you know, part of your investing strategy, some specific stocks, especially since growthy stocks seem to be especially vulnerable on days like today. And if we're going to get more volatility, it sounds like we might get more days like today.
Yeah, that's possible. But investors really want to own stocks that actually have structural advantages. And that's best evidenced by revenue growth, margin expansion, earnings growth, and reasonable prices. So the reason growth stocks will still outperform is that in a period like this, if we have macro uncertainty, they're going to be names with some visibility. It's not pleasant to own a growth stock today, but you know we know the lesson of 2025 is that these pullbacks have not been deep and investors have been buying these dips. So I don't think today is any different. In fact, it's no different than the DeepSeek panic or the tariff day panic or the CPI panic. So, you know, I think this is going to be a buying opportunity.
Now, what Tom Lee was referencing there with a wall of worry and why that's actually bullish for markets is because you need a wall of worry for markets to continue to move higher. You need to see these pullbacks from time to time and, you know, markets to continue to get over things. When you don't have a wall of worry, then, you know, ultimately you kind of stall out and inevitably start to move lower until you do get a wall of worry and then you really move lower. Okay, so that's important. I think it's also important what he said about interest rates. And I think that is true, especially with, you know, what we've covered here in this video. I mean, deportations, cutting government jobs, some of the weakness we're starting to see in the real estate data or further weakness in the real estate data in, you know, other data points as well. That really builds a case for interest rates to be cut by the Fed sooner than expected, and that will be bullish for the markets. The one thing that I would kind of defer on is the whole dips have been bought quickly in 2025. That's true. But if we get a real growth scare, if the economy continues to weaken and some of these, political surveys of inflation expectations moving higher affect the Fed into essentially not cutting the rates, not supporting the markets or the economy, fears are going to grow of a recession. And if fears grow of a recession, these dips will not be bought nearly as fast as we have seen so far in 2025 or in really just the last couple of years. That would be a more ugly setup. Now, here in this upcoming week, we do have some very important earnings. Domino's pre-market will tell us a bit about the consumer on Monday. Again, pre-market. Monday and after hours, you have Hims and Hers, Riot, Tempest AI, that's that Nancy trade, Cliffs, Zoom, Chegg, Trip.com, Diamondback, and others. Tuesday pre-market, you have Home Depot, Planet Fitness, Keurig Dr. Pepper, Digital Ocean, Krispy Kreme, American Tower. Tuesday and after hours, you have Kava, AMC, Axon, First Solar, Lucid, Instacart, Lemonade, Workday, Intuit. Wednesday pre-market, you have Lowe's, NRG, Advanced Auto Parts, AB InBev, Stellantis, and UWM. Wednesday and after hours, you have your big dog here, NVIDIA, Snowflake, C3 AI, Salesforce, Marathon, IONQ. Thursday pre-market, Vistra Energy, Norwegian Cruise Line, TD Bank, and some others. Thursday and after hours, you have SoundHound, Dell, Rocket Lab, Archer, Clover, Transmedics, Duolingo, and Opendoor. And then Friday pre-market, you have Fubo. Obviously, NVIDIA is a very important earnings this time around. NVIDIA is always, a pretty important earnings regardless. But I think it's a little less important this time around because the markets are not all hinging on NVIDIA. Now, we have a lot of clarity heading into NVIDIA earnings as well. We've gotten all of your major, market cap companies that have reported, your $1 trillion+ market cap companies, and they've all reaffirmed their full year CapEx guidance. There's not really a big shocker here. Now, if hyperscalers were pulling back that CapEx spending, that would be maybe a larger issue to contend with. But that is not happening. So I think NVIDIA is going to come out. They're going to kill it on earnings. They're going to raise guidance like they normally do. Question is, does NVIDIA move higher on that? Do they move lower on that? And how does that impact the rest of the markets? And honestly, I see good things ahead, given the sell-off that we've seen in NVIDIA. But you never know. And it's going to be a big volatility catalyst. I also think companies, again, like Domino's, Home Depot, Lowe's, we do have TJX, and some others, that will be important to kind of evaluate how the consumer is doing. Kava, you could put them in there. You could put even Planet Fitness in there to a certain extent. And I think these will also be important earnings. Now, as far as economic data, on Monday, you have the Dallas Fed Manufacturing Index. You're expecting that's going to get better. We've seen these indexes have come in pretty poor recently. We also have the Chicago Fed National Activity Index, expecting that to get a little bit better. And it's been, negative for a while now. Expecting that to be in positive territory yet again for the second month in a row. On Tuesday, we get a speech from Fed Logan at 4:20 in the morning. You do get the S&P Case Shiller home price year over year, house price index for December, house price index month over month, and CB Consumer Confidence. CB Consumer Confidence is expected to fall. You will get Richmond Fed Manufacturing Index, expecting that to fall, to actually get better from -4 to -2. Manufacturing shipments and services revenues will also be coming out. Dallas Fed Services Index will also be coming out, expecting the services side of both the Richmond Fed and the Dallas Fed to get a little bit better. You have a speech from Fed Barr at 11:45 in the morning, and Fed Barkin has a speech at 1 p.m. You also have a 5-year bond auction. Last yield on that was 4.33%. Yields are going to move higher. Question is there good demand or bad demand? And I think that will move the 10-year Treasury yield coming on Tuesday. Now, on Wednesday, you do get new home sales for January and new home sales month over month. Fed Barkin speaks at 8:30 in the morning. Fed Bostic will speak at noon. On Thursday, you will get your big data reports for this week. Durable goods orders month over month, you're expecting a positive 1.3%. Okay. Last month was negative 2.2%. So if that comes in, worse than expected, add that to a catalyst of growth scares as we now have going on. GDP growth rate quarter over quarter, second estimate for Q4. The prior estimate was 3.1%. We are expecting that's going to fall to 2.3%. If it falls to 2.3%, that's in line with expectations. That's not bad. If it comes in even lower than that, then you're going to have another catalyst to add to the growth scares. You also get initial jobless claims, expecting that to rise to about 225,000 from 219,000 last week. Again, if you start to see a jump in initial jobless claims, that's going to be another issue for investors to digest. Pending home sales month over month and year over year for January will also be coming out. And there's a lot of secondary data as well that will be important to pay attention to on Thursday. It's really going to be a data dump, and there's going to be a lot to kind of sift through. Fed Bowman speaks at 11:45 in the morning on Thursday. Fed Hammock speaks at 1:15 p.m. and Fed Harker speaks at 3:15 p.m. And then Fed Goolsbee speaks at 10:15 p.m. at night on Thursday. On Friday, we're going to get core PCE month over month, expecting this to come in at 0.4%. Last month was 0.2%, so obviously lower is better, higher is worse. Personal income month over month will be coming out as well at 8:30 in the morning, expecting 0.4%. Last month was 0.4%. And honestly, you want to see this come down because 0.4% increases to monthly income is not sustainable for a 2% inflation target. Personal spending month over month last month was 0.7%, expecting that's going to fall to 0.2%. Again, if you were to see like a negative number here, that's going to be an issue for your growth concern. Okay, for your growth scare, something we definitely want to watch for. Chicago PMIs are expected to get a little bit better. On Friday, wholesale inventories month over month advanced for January. Retail inventories excluding autos and the goods trades balance will also be coming out. That's usually not a huge catalyst for markets, for stocks, but it will feed into a new GDP estimate. It says here your next GDP Now update from the Atlanta Fed comes out Friday, February 28th, which is this upcoming Friday, via the data that I just shared with you. So, I think earnings is going to continue to come in good, but the economic data could show more weakness in this upcoming week. And that would be the issue as far as a potential correction. If that economic data continues to weaken, you're going to have an issue for stocks. Now, the S&P is at almost at its 50-day moving average at $598.82. That's your level of support right now. If you fall below that, you're almost guaranteed going to fall to about $591 per share. That is your 100-day moving average. The issue would be, the larger issue would be if you fell below that, then you could be targeting your 200-day moving average. If we were to hit our 200-day moving average from peak to fall, that would be a correction of about 7.65%. If we wanted to get to that 10% correction level, that would be the S&P falling to about 551. Now, with a growth scare, that is certainly possible. Now, that would be an opportunity, I believe, if that were to happen. But, with the current setup that we have, you do have to remember it is a trade-off, okay? Some weakening is good because it's going to bring down interest rates, or it's not terrible because it's going to bring down interest rates, okay? But too much weakening opens the door for, again, larger growth concerns recession concerns. And that's what we need to be watching for in this upcoming week. So let me know what you think about this information down below in the comments section. Ladies and gentlemen, have a fantastic rest of your day, and I will see you in the next one.